One of the most important things to a dividend investor is the annual dividend. As we look at Ares Commercial Real Estate, it's a REIT. It's a REIT that I'm very fond of. We can see that it has a dividend yield of 10% and it pays an annual dividend of $1.38, and it's only $13.74. That's pretty good. That's a pretty high dividend yield. But if we look at Ares consistency, it has consistently paid out a dividend and hasn't dropped in price since 2019, 2020, and then in 2021, it increased its dividend. And keep in mind, this is during COVID. A lot of companies dropped their dividend during COVID or stopped paying dividends altogether during COVID, but not Ares. So this dividend company looks pretty strong. So let's see what it would look like if we invested $10,000 into this company and how much we would get back at the end of the year. So with $10,000, we would roughly be able to afford 727 shares, 0.8 shares of Ares. And I'm on Dividend Watch. Dividend Watch is a great tool, I use Dividend Watch. I'm even signed up for Dividend Watch and I pay for Dividend Watch. You can check it out in the link in the description and in the comments. But Dividend Watch has a great tool and you about to see it in action. So if I wanted to, take that 727.8 shares, I can calculate it on Dividend Watch. I'm going to hit reinvest. If I reinvested the dividends, of course, we're going to use US dollar. You can put the taxes in if you want. We're not going to mess with that. And I'm going to put it in for 5 years. You can up how many years you want to put it in for. But I'm going to calculate the dividend income for 5 years if I put $10,000 into this REIT. Hit calculate, and it's going to populate it for you. So with this dividend yield, I will get this year in 12 months. So in a year's time, I would get $1,069 from putting $10,000 in this stock. All right. That's pretty good. That is great. That's pretty good. And then the total income, total target income for 2027 would be almost $2,000. So that 1,000 would increase to 2,000 if I just keep that $10,000 in there and I just let my dividends reinvest. I will have an annual dividend of about $2,000 in 2027. But the total dividends I will earn throughout the whole period, the whole 5-year period, would be $8,547. If this dividend yield stays consistent and if the company keeps paying a dividend of about the same, and typically companies increase their dividends if they are on the up and up. So yeah, that's the power of dividend investing. And that's the safest place to be in the market. I'm not even talking about the price of the stock. You see the estimate return, it estimated it might grow 18% over that 5 years. Whoop-de-doo. But as a dividend investor, your eyes are on that annual dividend income. And you're trying to increase that annual dividend income. So in 5 years, just for sitting your $10,000 somewhere, you would earn $8,547 just for holding that stock, regardless of the price. So, that's the power of dividends. Let's get into a little more in the video. What's up, guys? It's your boy Ty. I appreciate y'all coming to check me out on my channel. And if you're new to the channel, go ahead, subscribe so you can come back and see me. I talk about investing and what I'm doing on my journey. I talk about crypto, dividend stocks. For anyone that is just tuning in, this year has been my crypto year. Last year, I built up a pretty decent dividend portfolio. And after this year, after I load up on crypto while everything is down in the market, it's bloody. You guys can see right now, this is the crypto that I hold, and you can see these negative numbers. It's bloody. But I do think, crypto will bounce back, and while it's down, I'm gonna, keep dollar cost averaging into crypto for this year, and unless it goes green. When everything go back green, I'm not gonna buy anymore because I have a pretty decent amount in crypto. If everything goes back green, that I'm gonna be sitting pretty decent, and I'm gonna just wait it out after that. But while it's red, I'm gonna keep dialing in. But crypto is extremely risky. And before we go any further, this isn't financial advice. I'm not a financial advisor. I just give you guys the game, how I see it, and let you know what I'm doing. So I'm gonna keep dialing into crypto. These 4, I don't need a whole lot. I feel like I can get a good position in each one of these first. I feel like when you all spread out, you might not feel the full benefit of when something does explode. But I'm gonna keep investing in these, and we're gonna see what happens. But I already have a solid dividend portfolio. So crypto is extremely risky. But if you guys want to go a route that's a little more safe, dividend investing is the way to go. And as you guys can see, the stock market is getting hit hard. You see articles like Dow dives 800 points, S&P 500 post worst week since January after inflation hits 40-year high. Dow falls 880 points as inflation hits 40-year high. So inflation is running rampant. You can see it in the gas prices. You can see it in the regular grocery store prices. Man, every time I go to the grocery store, I feel like, man, no matter what I go in to get, I come out with a bill about $80 to $100. Like, what did I just buy? It's food, regular food. Our everyday needs and wants are increasing. The gas about almost $5 where I'm at. Man, I got a little small work car. Yeah, I'm filling it up like I got a SUV. I'm like, gosh almighty. But it's inflation. Inflation is doing that, and it also is gonna have a play on the stock market. So when we talk about the stock market, a lot of people, are wondering where should they be because stocks have been bleeding. Stocks have been bleeding bad. A lot of stocks fell from all-time highs. So a lot of people wonder where should they be. So when you talk about dividend stocks, they are a little more safe. For example, look at Coca-Cola right here. Coca-Cola hasn't tanked down like a tech stock, but it has been staying consistent. It looks like it's just been staying consistent. Coke grew 10% over the last year and 34% over the last 5 years. They say on average a stock growing 10% is great growth. And while you own shares of Coca-Cola, you can earn a decent dividend yield. Right now it's 2.75, but that's because the price is pretty high right now. But Coke pays a consistent dividend too. So we see Coca-Cola pays an annual dividend of $1.68, and it's something to point out that Coca-Cola is a dividend aristocrat, and it's even more than that. It's a dividend zombie. It has been paying dividends consistently and increasing dividends for a long time. So a company like Coca-Cola, You see Coca-Cola increases dividend in 2019, increases dividend payout in 2020, increased in 2021, and more than likely it's going to increase in 2022 because it wants to keep that status as a dividend zombie, as a dividend aristocrat, which means it consistently ups its dividend each year. So when we was talking about that earlier example, if you put your money into a stock like Coke's dividend yield is low though, because of the price, and they pay out consistently, and Coke isn't really one of those ones that's gonna have that exponential growth on price, and it's kind of already everywhere. When you talk about Coke's growth, Coca-Cola almost everywhere. You're gonna find Coca-Cola products on the shelves in different countries, so they kind of already expanded a lot. So now they're just keeping shareholders happy by consistently giving them a dividend payout that they know is guaranteed to come, because Coke has been doing it a long time. So when you talk about the safer places for your money, if you're looking for safer places for your money because maybe the market is getting a little hectic for you and you don't know if you want to invest in those growth companies, because growth companies are great, but you got to understand they're growth companies, so they're gonna have ups and downs. Growth companies are the main ones getting swing traded. Coca-Cola ain't really gonna get swing traded. It ain't gonna have exponential growth. It's just gonna consistently pay dividends. You see what I'm saying? Those growth companies that shoot up 20% one day, shoot down 5%, that shoot up and down like that, those companies are really the best targets for swing traders. Those companies in certain SP, like the SPY, like the SP 500, like certain ETFs, they are perfect for swing traders, and that's what happens with those growth companies. A lot of times people get in and get out, but when we're talking about high inflation prices, when we're talking about recession might go on, a lot of times people will run to the safer bets, like companies like Coca-Cola, the slow and steady, but it's gonna definitely get them what they need. So they like the slow and steady companies because they're gonna definitely give you a payout. If you own shares of Coca-Cola, you have no need to worry about if you're gonna get paid your dividend. So just keep that in mind. But these dividend aristocrats, they earned them titles, and a lot of people want to be dividend aristocrats. So if you are a dividend investor, as I said before, the main thing that you want to be paying attention to is that annual dividend. That annual dividend is, what's going to pay you. So if you want a high annual dividend, and this isn't financial advice, I'm not a financial advisor, go seek out one if you need one, but I look more towards REITs, which are real estate investment trusts, for higher dividend yields, because it's real estate and they have to pay out a certain percentage to their pay holders. All right, that's what makes them qualify as a REIT. So I showed you guys earlier ARES commercial real estate. As you guys can see, is down for the year right now. It's down 18%. 5 year is up only 2% because it just really stays consistent. If it wasn't for COVID right here, this real estate investment trust, it would just stay consistent and keep paying its shareholders out the dividend payments and increasing them. That's the whole goal of certain dividend companies. And like I said, they got a decent dividend yield. But you guys can see that the buy rating, that's just 6 analysts, but the buy rating is good, and they can be compared with others. But they have a killer dividend yield, and partly because they are also a small cap company. So To me, that means they have room to grow. So I like areas, but again, you can go with the safer bets. Like Realty. Realty is a real estate investment trust. Also, as you guys can see, they are down, but up for the year because they had the same type of thing going on like Ares. But of course, this is a bigger name company. It's a large cap company. So it has a little more growth going on. And when COVID hit, it dropped. But, it did the same thing, started to rebound. But you see their dividend yield is only 4.347. So you wouldn't get, if you put $10,000 in you would get half of what you would get if you invested into Ares. But your money would be safer because this is a dividend aristocrat. So let's look at on dividend watch. So as I said, is a monthly paying REIT though. I didn't add that, but it's a monthly paying REIT. So you get paid monthly with because when people have these dividend companies and dividend REITs, a lot of people are solely interested in the payout. For example, people with bank, they got more than that example of $10,000 I put out there. People with bank, they got $200,000 and they're in retirement or trying to retire and they just want to have their income come to them. Some people are like that. They are past the stage of reinvesting and, trying to grow. Now they got a bag. They got $500,000 or something that they want to put somewhere so they can earn income. A lot of retirees do that. And of course, we should be looking to do that too. But they use companies like Realty to make sure they get their money because pays a dividend of $2.86 and annually. But this REIT pays out monthly. So that's the annual, what you get annually. And it's a monthly paying dividend. And you guys can see. You're going to get paid out decent. You're going to get paid out decent. So it's almost 25 cents per share monthly. 25 cents per share monthly right now. But you guys can see it increases its dividend every year. 2019, 2020, 2021, and of course it should do the same in 2022. So people look for REITs like this so they can get that income. But it's a safe place to be if you don't like to look at stock prices go up and down. Because sometimes it can be nerve-wracking watching stock prices go up and down. It can. So dividend investing is an easy way to go without having to worry about stock prices. If you invest into a certain dividend company and they pay a certain amount per share every year and they usually increase it, you can just worry about how much passive income you're about to get, how much income you're going to be receiving from owning those shares. The price of the stock should never bother you if you are a dividend investor. Because some dividend companies actually don't grow really at all every year. They just stay kind of the same. But it doesn't matter to the shareholders as long as they are consistently getting their dividend payouts. And from there they can reinvest in the company if they want, or just take their payout and use their money on something else. So I wanted to point out some, good dividend companies. And I pointed out REITs, and one of my other favorite REITs is EPRT. Let's look at it on Robinhood first. EPRT is also down, but what I like about EPRT is new to the stock market. It's new to the stock market. So it hit the streets, it IPO'd in 2018. And since then it was taking off. Then it dropped down thanks COVID, but it kept going and now it's back up and down, but it's a fresh one. So I like this REIT. I think this REIT has great potential. As you guys can see, I'm down in my position. Oh Lord, I need to go buy some more. But as you guys heard me say before, I'm in crypto right now at the moment, and I'm gonna keep dialing in my crypto. But I like EPRT because it's a REIT that's fairly new to the market, and it pays an annual dividend of about $1 per share. But when we go down here, new to the market, but it has been consistently paying out a dividend and increasing it. 2019, 2020, 2021, it has been increasing it. And again, that's during COVID times. It didn't waver. So a lot of these REITs out here you be seeing, or a lot of REITs people recommend, they stopped paying dividends during COVID, or they couldn't handle paying dividends to the shareholders during COVID. You think they're gonna be able to handle a recession? Alright, now all I'm saying is, if they couldn't pay out a dividend during hard times, you cut my dividend off because of hard times, that's a company that I would be worried of, And we talking about the safest places. I showed you guys some dividend companies, but we got some other safe places in the market. So I'm showing you guys high paying dividend companies. So if you want a little, best of both worlds, a little bit of growth, a little bit of dividends, you can always go with companies like Apple. Companies like Apple. Apple has had a decent amount of growth over the 5 years. They had a decent amount of growth. And Apple is one of those companies that everyone has in their pocket. Literally, everyone has an Apple phone, watch. It's one of those companies that you can use common sense to see that this company is doing well. You can look at this chart, but you really don't need to know too much about it, just because if you use the common sense of thing, which I say it gets you far. A lot of this stuff in the stock market, people like to overcomplicate it, make it confusing, just so you can be like, man, it's too much for me to understand. But you understand that everybody has this product, right? You understand that people keep buying this product, right? You understand that this product is going to be around for a while, and it has been around for a while. That's all you really need to understand with Apple. All right, so Apple pays out a dividend, but you guys can see the dividend yield. It's not even a 1. People be like, yeah, they get a lot of dividends from Apple. How? Because it's 0.6. And that equals out to 89 cents annually. So one share that costs $137.13 is not even going to give you $1 from Apple. So Apple, if you hold Apple, you're going to be in Apple, holding Apple for, you can get a little bit of the dividends, but mainly for the growth. But as I said, that's one of those best of both worlds things. If you want a little bit of growth and not so much dividends, companies like Apple, I think Microsoft, as you guys can see, Microsoft had great growth. It kind of look like Apple. You slide down, you see they only had a dividend of 0.914. So you're not going to get a whole lot from Microsoft or Apple, but those are the type of companies that are tech companies that pay a dividend. And like I said, you can get a little bit of the growth and get a little feel of the dividends. But if you really want to know the best dividend stocks to invest into, I'm telling you, check out Dividend.watch. It's an all-in-one dividend tracker for dividend investors, and they have tabs. You can see all of the dividend aristocrats. You can see the blue chip stocks. It's premium. You have to sign up for Dividend.watch. You can see high yield dividend stocks, REITs, high growth, high yield, all of that good stuff with Dividend Watch. Dividends, like I said, the ones that got that premium, you have to pay for the Dividend Watch. And if you are interested in that, Dividend Watch is $64 per year. As you guys can see, I'm currently active. But if you guys want to sign up, make sure you use the promo code TY15. That's TY15. And you can get 15% off of your first membership with Dividend Watch. And Dividend Watch has been increasing their prices. And one thing that I would like to add is Dividend Watch also has been updating things. Like now, you can link your portfolio. So you can link your portfolio with Robinhood, Interactive Brokers, Ameritrade, TradeStation, Quest Trade, Ally. You can list if you got any of these brokers, you can link your portfolio with Dividend Watch. So Dividend Watch didn't have that at first. You had to manually input your stuff into Dividend Watch. Or, don't. You could have just, put it in there and didn't do anything. So, yeah. Dividend Watch has been, upping their features. They've been upping their features. So, I told people a long time ago that Dividend Watch is a great way to track your portfolio, and other places charge like $300 a year for this type of service. Simply Safe Dividends, look them up. They charge an arm, a leg, and a thigh for this type of service. But Dividend Watch is only paying right now is $64 a year. So if you want to look at Dividend Watch, check them out. But they have a great resource for finding the best dividend stocks. If you want to invest in dividend stocks, you can get your ideas from here. There's a lot of great dividend stocks, a lot of great places to look. And everybody, needs a little resource every now and then. I have several resources for my research. I don't know about y'all. But hey, that's all I wanted to talk about. The safest places to be and talk about dividend investing. So if you're one of those people that don't like to watch the market going up and down, maybe you can switch over to dividend investing. But if you want that risk to reward to be high, you want that reward to be high, you're going to have to take some high risk. For example, that's why I have a crypto portfolio too. I have my dividend portfolio, which is so slow and steady. I built that up last year. This year, I have my risky portfolio, which was going to be my crypto portfolio. And then next year, I probably just go 50-50. Maybe. It all depends on what crypto do. But I'm itching to buy more dividend stocks. But I'm sticking to my plan. And later on, make sure y'all come back for my video. Later on this month, I'm going to be doing the mid-year recap where I'm going to show you guys a little more in-depth my portfolios, especially my stocks. You can see what I got and my progression, my stocks and crypto. I should be showing y'all glimpses, but we don't talk about it, right? I'm going to talk about it and tell y'all about my goals and what else I'm trying to do for the year. And in that video, I'm also going to be giving away that first $50. Yep, if you don't know about that, make sure you check that out. It's the Stock Simulator Challenge. I'm going to be giving away $50 on the channel. Alright, so I appreciate y'all stopping by, checking me out. And again, make sure you know yourself. If you are not one for the risk, dividend investing is so easy. It's the long game. It's not the get rich quick, buy this and you can double your money in like 6 months. It's not that. It's slow, steady, but it's guaranteed. If you want that slow, steady money and it's guaranteed, and remember, a dividend portfolio. Your portfolio is something you can pass to the next generation. So let's say you got your dividend portfolio, and in your retirement, you don't gotta sell anything. In your retirement, your portfolio brings you in 20,000 high roller, because you should be getting that. And if you're about retired, but your portfolio brings you anywhere between $10,000 to $40,000 just for holding your portfolio. Okay, you pass away. Guess what? If you got dividend stocks, you can give that to your family and tell them don't sell anything. And whomever gets that portfolio can have an extra $20,000, $30,000